I remember the date very well, January 15th, 2023. We got a call from a woman who spoke very softly. She told us that her husband had passed away a week earlier. He had bought a term insurance policy via Ditto Insurance, the company I co-founded, and she needed some help in filling out the claim form. I was shocked for a moment because that was the first death claim that we had encountered. But I had to snap out of it quickly because we all knew exactly what we needed to do. We had to make sure that the lady received her dues. We had to get to work. It took a few weeks for the insurance company to process all the paperwork, but in the end, they paid her 1.5 crores tax-free. 1.5 crores. Now, needless to say, this money is nothing compared to the devastating loss that she suffered, but it will help her and her kids in the husband's absence. Unfortunately, only 3 in 10 urban Indians have a term insurance policy. Most people don't even know the difference between a life insurance policy and a term insurance policy. And so we've been wanting to do something about this at Ditto, explaining everything we've learned about term insurance while building the insurance aggregation business, and also telling you what you should be doing if you want to protect your loved ones. Hopefully, at the end of this series, you will have a better idea of whether you should consider buying a term insurance policy, and if yes, how should you go about it? With that introduction out of the way, let's get to the first episode. Today, we will be talking about 3 things. Number 1, what is a term insurance policy? Number 2, how to pick the right cover. Number 3, how long should you hold a term insurance policy? Also, I would greatly appreciate if you like the video and leave a comment here. It will help with the algorithm. Okay, so let's start with the first question. What is a term insurance policy? A term insurance policy pays out a large lump sum when the policyholder passes away. Now that's the simple definition, but I don't like this definition, and not because there's something wrong with it. It's just that it doesn't do a good job of representing what a term insurance policy actually does. So let me instead give you another example. Imagine this is Rahul. Rahul has a wife and 2 kids. He's the primary breadwinner in the family and he's 30 years old. Now Rahul bought a term insurance plan when he was 26, and since then every year he's been paying 12,000 rupees for a term insurance policy with a cover of 1.2 crores. And his policy will last until he turns 60, meaning the policy will pay out 1.2 crores tax-free to his wife and kids if he passes away anytime between now and the day he turns 60. If he doesn't pass away during this time and nothing happens to him, his family will not receive anything. He won't get his premiums back either. Now, some people will look at this and say, that's a bad deal for Rahul. Shouldn't Rahul get some money back, especially if he's paying his premium until 60? Well, maybe. But remember one thing. When insurance companies promise an extravagant return, they're usually doing it by investing your own money somewhere else. And they take a sizable fee in the process. So a better approach is to always keep your investment separate from insurance. If you want some money when you retire, you can simply invest them in mutual funds or ELSS, or even a fixed deposit. The fee structure is better here and you get to make more money in the process. So if you're thinking of buying a good insurance product, then please make sure that it has no investment component, because if it does, it won't offer good insurance, nor will it offer a good investment return. We will talk about this more in future videos, but for now, I hope you have a basic understanding. Okay, now that's out of the way, let's talk about the next important topic. How do you know what kind of cover you need when you buy a term insurance policy? Now, most people like to use a thumb rule. They simply choose a cover by assigning a multiple to their current income. Let me give you an example. If you were making 12 lakhs an annum, then you can simply multiply that number by 10 and buy a term policy with a cover totaling 1.2 crores. That is 10 multiplied by 12 lakhs. This is very easy to do. Unfortunately, it's not a very robust way to calculate the ideal cover. Why? Well, perhaps the problem can be best illustrated by using Rahul as an example again. Rahul is currently 26 and earning 12 lakhs per annum. He's single and living a fairly frugal life. And if you look at his annual expenses, you'd see something like this. Nothing too complicated. But he knows that this will change very soon. He wants to get married next year, buy a house, and even have kids soon after. He also knows that to cover these expenses, he needs quick promotions. He needs to double his salary over the next 2 to 3 years, and his expenses could rise at least 5 times by the time he turns 30. This poses an interesting problem for Rahul. Because look at the dependents column right now. When he's 26, his dependents include his parents, who need about 10,000 rupees a month or 1.2 lakhs per annum. But at the age of 30, after he gets married, his dependents will also include his spouse and kids. And all his expenses will go towards supporting the family because he's no longer single. So in the event of Rahul's passing at the age of 30, his family will need 15 lakhs per annum minimum. They may need even more as Rahul's kids grow up. Unfortunately, none of these details are captured using the thumb rule method. It doesn't capture his changing lifestyle, it doesn't capture his rapid increase in income, nor the change in dependence. So it falls short in many ways. My point is, Rahul shouldn't just be looking at his spending right now. He should be looking at the future. So at the age of 26, he should be projecting his future expenses, because that's the only way he can calculate the ideal cover. Now, I know that this isn't very easy to do and it won't always be super accurate, but it will give Rahul an estimate of what his family will need if he gets married and has kids and something were to happen to him, unfortunately. At this point, you could ask yourself one simple question. What if I use the thumb rule method once again? We multiplied his income by 12 and we got 1.2 crores as the ideal cover. So if Rahul's family got 1.2 crores at the age of 30, then how many years can they sustain without Rahul? Well, let's assume Rahul's family isn't financially savvy. The least sophisticated thing that Rahul's family can do with the money is to simply set it aside in a fixed deposit. If they do this, then they can use the principal and the interest from the 1.2 crore fixed deposit for 8 years without changing their lifestyle, as you can see in the illustration below. After 8 years, you can see that they run out of money. However, if Rahul were alive, then he would have supported the family until retirement, not just for 8 years. So in reality, the thumb rule method falls short of protecting Rahul's family's needs, because we now know that the family needs much more than 1.2 crores. Well, to figure out what kind of money the family will actually need, here's what you do. First, you project his family's expenses until 60. I've assumed that the expenses will rise with an inflation rate of about 5%. And I have added a buffer in the beginning to account for any miscellaneous expenses that may crop up in the future. For instance, expenses Rahul may have to incur as his kids keep growing older. I also know that Rahul would have retired by 60, during which time his children would be independent and his retirement savings substantial. This means by 60, his spouse would have ample funds to tide over the rest of her life even in his absence. So if Rahul wanted to cover his family's expenses until 60, he would need 4.6 crores. This is illustrated in the figure as you can see. And the 4.6 crores in a fixed deposit will cover their expenses at all times, meaning his family would always have enough money in the bank to manage their lifestyle irrespective of what happens to Rahul. This method of calculating the ideal cover is called the expense replacement method. And it's a much better way of calculating your total cover because it captures more details about who you are. And you can also do the same thing with income. Instead of expenses, project your salary into the future and then see how much money you will need from a term insurance plan to replace your entire future income. And I know that the math can be slightly complicated for some people. So if you have any questions about this, you can always book a call with one of our advisors at Ditto Insurance. Simply visit the website joinditto.in, book a call, click on term insurance, and our advisors will help you map your future expenses. They will also explain the math and tell you precisely how much money your family will need in your absence. It will be personalized for you. I've left the link in the description box below, so please check it out. Anyway, now that we have some idea on how to calculate the ideal cover, let's look at what's the ideal term for a term insurance policy. Question that usually pops up whenever I talk about this is rather simple. Should I buy a term insurance policy that lasts till I'm 99 years old, or should I go for a term that's something shorter? Now, for most people, the second option makes a lot more intuitive sense because most people know that they'll die by 99. This way, the dependents will always end up getting the money no matter what happens. However, the truth is this kind of thinking is slightly problematic. For starters, you have to ask yourself, why are you buying a term insurance policy in the first place? And no, it's not a multiple choice question because there is only one answer. You buy a term insurance policy to support your dependents in your absence. That's it. And at some point in your life, your dependents will stop needing your help, your income. Your kids will grow up, your spouse will have a retirement corpus, and you will have built significant savings that will last your lifetime. And for most people, this happens between the ages of 60 and 70. After this, you won't really need a term insurance policy. So why are you buying a policy that lasts till 99 years? Is it because you want to leave a legacy? And I can understand that sentiment if that's your priority. But I'm not entirely sure that this is the best way to leave a legacy in the first place. If you're buying a 1 crore term policy right now, it may look like a mammoth figure today. But 50, 60 years from now, that 1 crore will not be worth a lot of money because of inflation. It could be meaningless, in fact. And finally, look at the premium charts here. See how your premiums start increasing rapidly as you buy a term insurance policy that lasts beyond the age of 60. At some point, the premiums become so laughably expensive, mainly due to the fact that even the insurance company knows that you're likely to pass away at this age. They will try to recoup as much money as they can, and you'll end up paying a higher sum. My point is, if your agent is asking you to buy a term policy till the age of 99, or if you're considering it yourself, it doesn't make sense for you or for most people. What you should be doing instead is this. If you feel like your dependents will be well settled by the time you retire, say when you are 60 years old, then buy the policy till 60. If you feel like they'll be well settled by the time you turn 70, then buy the policy till 70. And if you have more money to spare, buy a higher cover. That way, at least your dependents will get more money when they actually need it. And if you're planning to buy a policy that lasts till 80, 90 or 99 years old, irrespective of what I said so far, then I urge you to please reconsider that option because it doesn't make a lot of sense for most people. Anyway, that's it for me for now. In the next few videos, we will cover more things related to the subject. Things like how to pick a good term insurance policy, what are some of the things you should avoid when buying a term insurance policy, and in general, some do's and don'ts. Until then, I hope you liked the video. And if you did, don't forget to leave a comment and subscribe to this channel. We will be posting more interesting content soon enough, so keep an eye out for that. All right? Okay. Bye-bye.